All right. Hello, everybody. I see some folks getting in here, which is awesome. What is this? Our second. Welcome to our second AI Circle of July. Before we get Kelly in here, I'll just announce the next couple. We try to plan them out a month or so in advance. So if you guys want to put on your calendars, you're welcome to. We'll obviously send out the emails as reminders, but in August, we're going to go for the 6th and the 20th as of now. I know we talked a couple times ago about potentially doing a third one in July, but I will actually be on a plane during our scheduled time. So we'll just skip that week and come back the next week. So with all the minor housekeeping out of the way, Kelly, how are you doing?
Ah, I'm watching paint dry with the market.
Yeah, not I was kind of looking before I opened this up. The market's pretty much in the same spot that it was, maybe slightly better than what was it? July 2nd was when our first one of the month is. I mean, things are at all-time highs, and I don't know what there really is to say, but you always have something insightful to share, so I'm sure people will be happy that they're here.
I thank you. Wow, really? I wish I could bring life into death and raise Lazarus, but no, Lazarus. If I ask him to rise, he's staying down. Um, no, everything's fine. There's the disclaimer, everybody. Make sure to kind of read that. The idea is these are my opinions. And mine alone. And so I'm not giving advice on this show, but I do talk about things, and these are my opinions. And um, if you want to make choices on these things, get a hold of someone that you think if any of my ideas are worthwhile or not.
Yeah.
So I think that's the gist of what a disclaimer is.
Yeah, and I mean, we always go over the disclaimer, but one thing maybe we don't say, and folks that are new that are maybe just learning about who iFlip is, like, we don't give advice as a company either. It's not just that, Kelly or I can't, like, we're a software company. We use, of course, AI in the stock market and all that, but none of us are, licensed investment advisors that will ever give you advice. So we're kind of a do-it-yourself type platform, but of course we have some pretty cool tools that hopefully enable better success.
Then that being said, I did have a career where I peddled my wares and my services to many Wall Street firms in my career, based on my knowledge of trading, um, algorithms at the time, and then neural networks later, and ultimately machine learning. So I do. There's a lot of people on Wall Street that knew what I did and hired me for my services, and I'm very thankful for that and grateful because I learned so much during my many years, ruining leather on New York streets. So, not that that was a bad thing. I didn't mind it at all. It was a good career.
Awesome.
Um, where should we begin, Lee, today? I think I'll jump into kind of. I think today's format. Maybe I'll change it up a bit. We'll go over some of the markets, but as I think most of you know, um, yeah, the market's higher than it was in May, where normally there's an old adage of sell in May and go away. That may remain true if the market were to come down about 5%. That would also mean we would go back to where we were at the end of May. Um, the difference is this year is that we should just think about what's the context of why the markets had that real quick jump up at the end of June. And then, of course, because they were stagnating for about 2 months prior to that, where they didn't really move. April was a big recovery month. There was a little more recovery in May. Then from May till almost the end of June, the market stood steady. Then it made a little jump up. That last jump up was due to maybe slightly better inflation numbers, but also the fact that Trump is definitely, you can definitely tell that he's using tariffs as a as a as a weapon to get other countries to make deals with him. Trump is a deal maker at the end of the day, and we also noticed that if a trade deal wanted to occur but didn't, he gave them more time and he extended it. So that's what's caused all the most of, if not all, the fear of the tariffs to go away. And by the way, his first administration, it was the same way. I remember, Lee, you'll remember this, the tariff wars that came in December of 2018. He put a huge tariff out on China. Market went down 20% in less than 2 weeks. And it bottomed on Christmas Eve of 2018. Everybody, please go look at it. I could show you with my chart, but I won't. And then it proceeded to recover the whole thing over literally from the Christmas Eve, the day after Christmas, all the way through January. It was as if it never happened. And again, this is the same behavior as what we saw then. And so the tariff scare that we had earlier this year was definitely a buying opportunity, because he definitely wields that as a weapon. It's not like he wants to put the tariff in. He uses it to get people to come and talk to him. And it seems to work, because the market is at all-time highs right now. Let's take a quick look at the Dow. Here's the all-time high right in here. And, you know, we hit it right here. That day, right around there, we had a high, which was around June. Was that last Thursday?
Yep.
So so when I see this, where are we now? And notice, by the way, over the last 7-8 days, we haven't moved. If you can see closely, we had this congestion period, this little bump up here, and then another congestion period. So where's the market going? That's the Dow. Let's zoom in before I answer that question. S&P looks about the same thing. Market's kind of steady here, rising significant, not much, then a little pop, no movement. The market right now is really poised and coiling to go higher. Here's my reasoning behind it. The future of interest rates definitely looks like interest rates will be cut within the next few months. I think the cut will be at least 0.5%, not a whole percent. I'm sure Donald Trump threatening the Fed Chairman Powell for 1 point, 2 points, 3 points. That's ridiculous. Powell will very likely, though, yield at the end of the day to about 0.5 point. Somewhere, my guess is, it won't be in July, but it could happen late August or maybe early September. And if the interest rates go lower, the first interest rate cut after a series of interest rate hikes is always the portender of future further interest rate cuts going forward, which means that really should put a kick into the stock market and actually revalue it probably by the end of the year, should that cut occur, at least 10% higher than it is right now. And if that's 10% higher and the S&P is at 60, call it close to 6250, that means it could go up another 620 points. That puts it at around 7,000. Just so you know, that's here, all the way up on my screen, way up here. And I wouldn't be shocked to see that over the next, say, here's October of this year. Is that really a surprise to see a little vector of the market moving up to 7,000 by the end of the year? It's not. An interest rate cut will do that. Trade deals with Europe, which he says will be imminent, will definitely matter. The two fundamental things that also make the market go up higher is a complete deal with China and a complete deal with the Euro community, because those are, after all, the biggest trading partners. All the other ones really don't matter. Those are things that are just odds and ends. What matters is the big ones, and those are the two big ones. Those things occur, that makes the market go higher. Interest rates are not going to be raised, they're going to be cut. Interest rate cuts almost always portend higher stock prices in the ensuing 6 months. And we're already 6 months through this year. So the market's poised to go higher. There's no reason to be short this market. But that doesn't mean that some things aren't breaking down. And I'll show you a few of them. And a few of them are the things I like. So we'll get into that a little bit. And let's just make sure we know. So with the Dow is close to its high, just barely off it. S&P's on its highs. You're right here. And of course, the Nasdaq, same situation. Markets are on its highs. This, of course, was the V bottom that we ended up having because of the tariffs. Kind of interesting how they always seem to move down to 2 standard deviations lower. Let's look at some of the stocks. Let's look at Apple. Apple has been definitely one that has not done a good job of recovery. A lot of that's due to so much sales in Asia, China, that if we have trade wars, that's going to cost Apple because so much of their business is there. So that hasn't recovered so well, but the other stocks really have. Amazon is not too far from its highs. Google kind of trying to make another run. Look at this series of higher highs and higher lows. Meta, wow. Back up, down, back up, made a new high, back up. I expect Meta to be $1,000 stock not too far in the future. Netflix brand every day seems to be a new high. Today it's not, but look at the highs that it made. We're at $12.50 now. I remember when the thing was $300 a few years ago. Microsoft, great company on its highs, pays a small dividend, always a good thing to own. After all, they went to 360. They're a SaaS business, and they force you to own their software every month now. Nvidia, everybody knows that story. Now, I think it's the most highest cap company in the world with $4 trillion, bigger than everything else. The AI movement, of course, yeah, it is for real. Our company is based on machine learning. Thank goodness, because machine learning it will at some point become for the masses. I want everybody, there's an article I'd like to see if I can find for you that Goldman Sachs actually hired the first robot coder. And think of it, a robot coding. Oh, I'm frozen. Let me fix me. Lee, you got to tell me when I'm frozen.
You're good. No, the audio is coming through just fine. So sometimes that happens with the screen share.
But I might have a funny face, so I hate it when I have a funny face. Let me see if I can get back to being a normal human being. Let's see. There we go. Let's get my cam going. I'm back. I'm a real person again. Thank you for that, for letting me know, everybody. So again, Nvidia is the company that represents machine learning and all the things that we think it's going to be in the future. And it really is going to be those things. It's a future that I don't think any of us can really envision completely, but it is a different one. And very likely, I hope, a better one. Let's talk about some of the stocks that I follow quite a bit. We all know we've had a profound focus on energy of this company, energy and technology, since Flip was formed. Why? Because those are volatile things that are highly traded and really respond well to a learning environment in terms of its data for machines to learn from. And this is why we focus on the tech sector and the oil sector, because the machine learning really does work in these areas in particular. And as we can see, energy, it had its spike high again. This has, during, not during COVID, but during the recent Iranian move for both Israel and America, bombing their nuclear facilities. They thought energy would really go much higher, but nope, it did, and it spiked way lower. We're still in a general downward movement in oil, but some of the companies are still just hanging in there. I mean, here's ExxonMobil. It still pays like a 4.5% dividend. It hasn't moved anywhere despite oil going down. It's still maintaining about 115 to 110 a share, even though oil has gone literally from $90 a barrel all the way down to 65. Some of our favorite companies, I think you all know, Energy Transfer and All Plains American. So Energy Transfer first, again, these are now paying back at 8% dividends, and they are off their $21 or almost $21 highs. and they're now printing at about 1750. So they're off their highs. But interestingly, oil, they're not really necessarily a function of oil. They're a function of their infrastructure being repriced. It's not cheap to lay a pipeline. And these companies are the pipelines. What do? They lay the pipeline, pay for that, and then they pay a lease to the land they go over. And the land they go over, of course, are owned by other companies like Landbridge and Texas Pacific Land, companies like that. So these companies have done well. They pay a huge dividend. We kind of just want to own them. These are not AI traded because we care about the dividend. And in this particular case, Energy Transfer, it's kind of hanging in around 1750. I still think it's going to 24 bucks a share, and it's just a pullback in the short run as we adjust to all kinds of new information and a new president. Plains All American, again, a great stock. Same thing, really hasn't moved anywhere. It was $18 a share, literally a year ago, April. And it pays the 8%. It moves up and it moves down, but I'll take the 8% because it's a kind of a guarantee. They always made dividend even during COVID. If this stock goes to 24, where I think that means that's a 33% rise from the current price, and it pays you 8% in the meantime to do it. So I still like owning this. I personally think this particular company is going to go to around 20 over the next, say, 2 or 3, 4 months. And it's going to pay a dividend in that same period. It's going to pay 2 dividends. We have a dividend coming up at the end of the month. We'll quickly jump over to the banking sector. This is JP Morgan, good representative of it. We're making new highs. There's no reason for banking to fail if we have lower interest rates. That hurts banks generally. Their spreads come in. But in general, it also means they increase lending. So they get the fees from the lending fees as opposed to the spread between higher rates and prime rates and what they offer to their best customers. Goldman Sachs, look at that move up from the tariff lows. Huge move all the way from 450 all the way up to 700. Is that 700? Wow, it's hard to believe some of these numbers. They just did that literally in the last 3 months. So that was a good buy. We can move down. Here's the one that some of you might have, Fannie Mae and stocks like this. These are stocks that, again, some of you may own in the portfolios. And what they represent is what I suspect is going to be a chance for people to get cheaper interest rates on their homes for first-time home buyers in the future. With interest rates remaining so high, it's hard for first-time buyers to enter the market because they don't have enough capital and rates are too high. Companies like these are able to offer, under mandate from the government, lower interest rates for first-time home buyers than you or I could get not being first-time home buyers. That's why these things are increasing. They're privately, even though they're called a government-owned entity, they're just increasing in price, and they're doing it with no volatility. Let's speak, by the way, briefly to volatility. Everybody says that we're in this new high volatility world. I don't see that. No matter where I look, I don't see volatility. Let me show you why. Here's the VIX. To me, it looks like it's on its lows. We have these spikes. But volatility remains on its lows, and it has, honestly, for years. For years, it's remained on its lows. So when people speak of this higher volatility, I just don't see it. I don't see it. And I wonder why people would speak to that when you go to a television station. I don't know it. Let's go through a few other stocks and get a little broader. CrowdStrike, great company, does AI, offers security for people on the internet. It's made new highs. It's off its high. It's probably a good buy to go even higher right in here. Here's one that the cruise lines have done very well recently. Strangely enough. Why is that? Maybe expected lower interest rates, more people employed, unemployment coming down to the normal kind of what they call full employment number of about 4.1%, which is where we're at. These things have done well. I think they have a little more room to go, but that's about it. But they have been a good play. They're from 17 to 29 over the last 3.5 months. Hey, to me, that's a 50% move. Here's a stock I'm disappointed with. We'll see what happens here. A lot of you know that in our portfolios, we have Landbridge and Texas Pacific Land, these two companies. They were up moderately today, but that doesn't mean anything. But when I look at these companies, I like them both. But I also like things that show me some love. Now, the reason I liked them and why I applied machine learning to them was because my thinking is that in a world of more data centers, we're going to have to put them on land. And these are companies that just buy land. They're real estate companies. And they buy their land and they lease it out. Who could they lease to? Well, they could lease to a pipeline that wants to run a pipeline over their property, or they can lease to a data center or any other kind of service center, like an Amazon center. But the reason I'm disappointed is because AI or not, I still like to know that we have a fundamental reason to own something, or even say, let's try to use data to dictate how we own it, because we just generally want to own it. We are a buy and go long only company. We never short the market. And honestly, that's generally the smarter way to play it in general. And I could love to argue with anybody that would suggest otherwise, even though I was one of the people that would have argued many years ago against. But if we're hearing all this stuff about AI, then why are these stocks going down? I got to get my arms around that. Why would they go down? You would think in the euphoria of it, these stocks would have a bid. The one thing I will say is they seem to be pretty thinly traded, which means they always trade with very low volume, and people that own them are institutions. 70% of these stocks are institutionally owned. The institutions are not going to sell them. So all the trading activity is really occurring either from speculators that are just growing tired of their investments and selling it, in which case what will happen is, if that's the case, then sometime later in the year, the institutions will say, we own some of this, it's cheap enough, we're going to buy it again, which does seem to be the pattern. This, for example, was what happened in the fourth quarter of last year. Look what happened. I mean, Landbridge went from $38 a share all the way up to $75. It doubled in 3 months in that same period. Then it stayed and oscillated here. In the meantime, we are getting closer to September. We could be either at a low or maybe make a new low and shake some people out. But I'm an owner still, but I would be buying more of this stock if it was me, without machine learning, at a little bit lower price, maybe around $50 a share. Same kind of thing goes for Texas Pacific. Look at this again, same thing. It was also last year, Texas Pacific went from 800 to 1,800 and then fell back quickly. So it went up $1,000 a share in just a short period of time. I don't want to be short in these kind of stocks into the fourth quarter, and I don't want to not own them then. This is just a question of patience versus capital. If you think your capital can do better between now and the end of the year somewhere else, I can understand it, because these things testing patience currently. Right here, I think this is a pivot point for Texas Pacific. I do think it'll be a buying opportunity here, or just slightly lower. Maybe there's a shakeout left. But I definitely want to be an owner of this sometime in August if we own it now. We'll move on a little bit further. There's not much left. Look at Tesla. I look at Tesla always as a trade. I like the company. You got a owner that is political. He has all kinds of things to say. He's a brilliant man, obviously. I have nothing I could ever say bad about Elon Musk. I will never bet against him. But I can tell you this stock, I just don't know if this is coiling to burst up to the old highs or above, or or if we're just waiting for something else to drop to make the stock go lower. My bet is it goes higher. Why? Because I think the overall market is going to go higher and it will lift all ships. A few other things. Might as well just end on this one as I've yapped for about 20 minutes. IBIT, which represents Bitcoin, I'll actually just go over to the crypto and just look at Bitcoin itself. Well, here we are. This also ties back to our BitFlip portfolio, which we are now 100% long in currently. What's going to happen here is we saw a jump, as you saw. Why? It was crypto week, I think, last week and some of this week, and the market jumped because there was a crypto symposium and how everybody's getting together to unite around crypto and where its future is. And uniting means, hey, it brings optimism to the space. And let's, no matter how you look at it, this is something that is now very real in our minds. We're all, I would bet 100% of the people on this call own it in some shape or form. I'm one of them. And when you think of it, where does this go? Well, look where it's came from. We must remember that. If I go back, this is going back 10 years almost. This price here, just so you know, was 3,000 bucks a coin. And I think some of us remember that it was even cheaper than that. If it was 3,000 and now it's shows it at 119,000, wow. If it's 3,000 to 119, so that's an increase of 40% over the last. 4,000% over the last 10 years. Where does this go? 500,000? That's where I think it goes. I saw numbers of 350, but if it goes to 500,000, sure seems it's pretty cheap at 120,000. And so it's not it's an ownership thing. This is not, we trade it, yes, but it is an ownership thing. It's at some point there will be no more to mine. And so the miners are willing to pay more than the price of it right now in electricity costs and server costs just to own it, because they know the future price, or they feel so confident that the future price will be a great deal higher. This is something that all of us should have some exposure to, in my mind. That's my opinion. And that exposure is not just 1 or 2%. It could be literally 5-6% or even more. This is something that has different kinds, very much like machine learning. This is something different. It is no longer something that lives in the ether. It exists. Everybody owns it. It's fungible. It'll become more fungible in the future. So owning of cryptocurrency, yes, it will have volatility, but any dip probably should be bought for the long run. So that's actually the way the BitFlip portfolio works. Dips are not bought, but you buy rallies, because rallies generally extend themselves in this market. So the idea is to buy a rally, try to make a profit, let it fall back. Let's buy another rally, get out, make a profit, and then let it fall back, try it again and again that way. That's a successful strategy in many highly advancing markets like this. I think I've kind of covered the overall. If there's any questions, I think now is a good time to take a few.
I'm glad you got to Bitcoin. That was going to be my last point. I know it's another thing that's at all-time highs.
Yep.
Not really any questions. We just had one on what the symbol was for energy transfer, which I answered. Someone else said they're looking to. Yep. That's a easy one. It's only 2 letters. I don't think we really have any other questions. So we might wrap this up right on time. Okay. I'll let the.
Yeah, there's at the end of the day, Lee and everybody, whoever is out there, at the end of the day, there's not much going on. There isn't much to say. The markets they're in this kind of quandary, and they're coiling, what they call a coil, to likely go higher, because we know that in the future there is going to be an interest rate cut, unless something really drastic occurs, some huge uptick in some kind of inflationary number occurs, these interest rates will be cut. And the cut will not be 25 basis points. But whatever the cut is, there will be future cuts. And that always portends for a stock market that goes up in the ensuing 6 months. If the stock market goes up, Bitcoin will go up, Goldman Sachs will go up, all boats will lift in that kind of environment. And so I'm expecting an interest rate cut myself sometime before the end of the summer.
Yep. Well, sounds good. I think we're going to wrap it up right on time. I announced it at the start, but in case anyone jumped in a couple seconds late, we'll have the next AI Circle on the 6th of August. So I believe that's the first week. Yeah, it should be. Yep. First week of August, we'll be back, followed by the 20th. So we will see you guys back in, what is that, 3 weeks or so? And we'll see next time if the market's done anything else. And it seems like the last few, it's just been not a ton to write home about, but that's not necessarily a bad thing. No big problems.
Let the money sit there because there are dividends being earned in almost all the people's stocks, at least on our platform. So let them occur. The markets are not always going to go up. What we care about is that they just stay steady, that they rise, they pay dividends, and if they dip, we get something to do, either through an opinion or some thought that might come out of my mouth, or hopefully even better, that the machine does a better job of buying these things properly than I can.
Yeah.
So until the next time, everybody.
We got one last question that came in from Mario. It's just to reiterate, can't say that word, something that we've talked about before, kind of at a high level, exactly what we're designed to do. So I'll let you take it from there.
Good. Thank you, Mario, for bringing that one out. Again, the idea when you place a trade, the idea should always be that when you buy a stock or you buy anything, you're hoping that you're going to get some long-term utility from owning it that outweighs any risk you had of the money you put towards it that you could have spent somewhere else and got, say, a risk-free rate. So right now, if you don't buy anything, you get 4%. If you get a money market somewhere, if you're lucky enough to get a money market somewhere enough at 4%. And if you buy something, you obviously want to make more than that. But that means that's kind of the risk and reward of buying something. So when Flip puts trades on through the machine, not through any of my opinions, but my opinions work the same way. When Flip puts a trade on, it's expecting that the downside risk of the stock is going to be much less than the upside reward. That's how the machine actually is looking at things. It's looking at many kinds of different variables. And when it sums them up, and right now, actually, one of the things the way I can count it is there's like 188 of them. And if you have 188 variables and you can say that the lion's share of the valuable variables are pointing to go long, it means that the risk reward is of owning it is favorable, which means, hey, I have a chance that my risk is $1, but my reward is $2. It works on ratios like that. And the idea is always to never place a bet where I feel I got even odds. If I want even odds, I might as well go to a casino where I can bet on black or red. And even that, because there is green and zero on roulette, where my odds are not exactly even. They're just 49%. The casino always wins, right? So at the end of the day, all these things are always put on in terms of a machine, looking at that ratio. Are the rewards greater than the risks by some amount? And by the way, it's much more than like 10% or 20%. We do try to make it where we feel that if we get stopped out, I'm going to lose $1. And if I make money, I'm going to make $2. So that's, of course, not what exactly happens because we buy stocks at different prices. But that is fundamental in any gambling business that we might do, is we always play the odds the best we can. And a machine learning that we use definitely puts the odds in our favor because it's able to look at, I just mentioned 188 variables. Who on earth as one person can look at 188 things and make a decision quickly. I mean, I might look at 5, 10 that are like my favorite indicators. And I say, well, they're all lining up. 7 out of 10 are lining up for me to buy it. So I'll buy it. That's the way it used to work. Today, a computer can look at hundreds, if not thousands of them and make the same kind of decision in an instant. That's what we're up against, by the way, with machine learning and AI. And there is no way that a human being can do that. I do believe, just in that one, Lee, and for Mario, I do believe that the future of it, of investing, really is a machine learning. And the question is there seems something to be inherently crazy about that. But at the end of the day, that would probably say that, wait a minute, nobody could lose if that occurred. And that would actually steady the markets. And the markets, they may not go up and down 30, 40% in a year, which you and I have, because they can go down 20, 30%. You might have a world where the market makes the same as an interest rate, like 8%, 9%, 10%, but it makes it consistently. So that's maybe where we could go in the long run.
Fascinating.
That's actually an excellent question, Mario. And I'm glad you reminded me to reiterate that
company.
Today.
And the only thing I'll add to his question, and a lot of people know this, but when he said how we differentiate ourselves by only going long when the upside's greater than the downside, just one key word there, long. Like, we never short the market. So anyone who doesn't already know that, most of you probably do, but I get the question enough that's worth bringing up.
Yeah, go long, because 85% of the time the market's going up. And so why do I care about the 15% of the time when it's going down? I'd rather just step aside. That's why we get out. We try to make our best attempt to get out. Doesn't mean it always works. But generally, if we can get out before that and then buy it a little cheaper, that's really a good bet for the long run.
Awesome. Well, Mario, thank you for the final question. We could have taken that for another half hour and talked about all the different pieces of all of the parameters and many other ways I could have spun it. But thank you again for the question. You have something else, Kelly?
Yeah, I was going to say, actually, next time, maybe I'll show everybody a screenshot to kind of further, if it's an interesting topic the next time, Mario, to show a screenshot of what those 188 things look like. And so, because that is actually in our back end, we have a huge set of variables that we look at, indicators. And it's not like I can look at them, but I can tell you this, a machine can. And a machine can tell you which ones that work and which ones don't. And that becomes the fundamental decision of how a machine learns.
Awesome. Well, we're going to cut it off there. Thank you, everybody, for being here tonight. Have a great next couple weeks. And like I said, we will see you back here on August 6th, same time as always. And have a good rest of your July.